Welcome to the Market Huddle with Patrick the Content Machine Ceresna and Kevin the Macro Tourist Muir. So grab a drink, get comfortable, and get ready for a deep dive into the markets. Take it away, guys.
It's December 21st, 2018, episode number 7. I'm Patrick Ceresna.
And I'm Kevin Muir. Thanks for taking time to join us. The Market Huddle is a weekly show where Patrick and myself get together over a couple of beers to talk about the week's action in the market, making sure to keep each other's feet to the fire and have a little fun in the process.
This show is broadcast as both a podcast and on YouTube. So if you are enjoying this as a podcast and feel like you're missing out on the charts or videos we are referencing, you can register at markethuddle.com website to get the weekly email, which includes the chart pack and the video links, or just flip over to YouTube. In this week's episode, we're going to touch on the most important things that happened this week. We're going to be looking at Powell, Trump, and ask how oversold is this market.
In our This Week in Trading History segment, we look back to when Ivan Boesky was sentenced. And for this week's WTF Clip of the Week, we have Alan Greenspan making some comments about the market.
In our Tales from the Trading Desk, we're going to take a closer look at using option spreads and end with the 5 most important things to watch next week. So let's jump right into it.
Patrick, a quick question for you. Who's the show brought to you by this week?
Well, this week it's brought to us by Alka-Seltzer.
Now, I don't know if anyone can hear, but Patrick's sounding a little rough. Now, Patrick, why don't you tell us why you're sounding a little rough?
Well, yesterday, actually, we're recording here on Saturday morning.
Which is usually we do Friday nights, and we're doing
we
Saturday.
crack open a beer and we shoot the shit about the markets on Friday. It's Saturday morning, and I'm a little hungover because yesterday was our annual 12 pubs of Christmas.
The 12 pubs of Christmas. So what does that mean? What do you do on the 12 pubs of Christmas?
You have a pint at 12 different pubs all in one night.
Holy smokes. So you made it.
I finished it. I did. And
did everyone make it? Like, did all of you make it?
No, I actually have five guys went the distance. We had about, at our peak, we had about 30 people there. But they kind of straggled on. They joined halfway or they left early. But 5 of us went the distance.
So only 5 of you can truly claim they made the 12 pubs of Christmas.
Exactly. And I was one of those 5.
Boy,
so
that's a shock, Patrick.
Yeah, but my head hurts, and I'm looking at this market, and when I'm looking at this market at the same time as my head hurting, it just makes it a lot worse. This Alka-Seltzer is really nice right now.
Okay, so let me do my legal stuff and get this out of the way. Clients and employees of East West Management may hold positions in securities mentioned in this podcast. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. For more information, please visit eastwestfunds.com.
Kevin, what a crazy week. This is I was looking forward to this segment with you here. So in your mind, what was the most important event of last week?
Well, it has to be the FOMC decision. And it's been a long time since we've gone into an actual FOMC decision where the outcome was not a sure thing.
Right.
Usually,
well, actually,
you go in.
It was almost a sure thing a month ago. Everyone was pricing in like December was a guaranteed rate hike, but that really changed in the last 3 days before the FOMC, right?
You're correct. And one of the reasons that it changed was when Stanley Druckenmiller and Kevin Warsh, who was the front runner for Powell's job, wrote an op-ed in the Wall Street Journal encouraging the Fed to pause and to take a pass at this week's hike. If you look, the Wall Street Journal editorial piece was titled "Fed Tightening, Not Now." And it was really it was unusual for someone of Warsh's stature to write something so openly to the Federal Reserve Board to say don't tighten.
Right. It was crazy. And you're also commenting, actually it was last week we talked about that David Rosenberg tweet too, right? We have basically oil collapsing, the global markets are in full slowdown, bear markets internationally just rearing their head everywhere, and it's like the Fed is, or at least I got the impression that Powell really came across, no, everything looks fine. This is the way things were planned, and we're just going to stay the course, right?
Well, yeah, and so we had Warsh, we had Druckenmiller, we had a whole bunch of really smart guys saying things like David Rosenberg's quote was, oil prices have collapsed nearly 40% from the nearby highs. Never before has the Fed tightened policy into such a free fall in crude. So why do it? Why do it now? Look for the Fed to take a pass tomorrow. This is not about political pressure, but rather receding inflation expectations.
Right.
And this was the thing. The market guys were all looking at what the markets were telling the Fed and saying, take a pause. Don't bother. You no need to do it. Inflation expectations are coming down. Credit spreads are widening. There's lots of reasons for the Fed to take a pause. And yet, what did the Fed do? The Fed came out and did the exact opposite. They said, no, they acknowledged in the slightest way that they were looking at market expectations, but said, no, the real economy is doing fine. Unemployment is low. The inflation expectations, although they're below, they're still close to 2%. And we're going to go ahead and tighten. We're not going to let the markets go and dictate to us what, put us off our plan.
Right.
And I think that one of the interesting things is that I have this pal, David Obront, that he tweets at Obront on Twitter, and he reminded everyone, he says, if risk-taking does not threaten financial stability, it is not the Fed's job to stop people from losing or making money. And that was a quote from Jay Powell in January of 2017. And
right.
Powell has been
That's
consistent in that he has been saying that I'm not going to go and worry about every tick in the stock market. And
right.
and the market guys were sure that this time was different, and that if they applied enough pressure, that Jay would cave.
David Tepper also came out, and he basically said that the Fed put is dead, right?
That's right, and that is in essence what is going on right now. The Greenspan put that turned into the Bernanke put that turned into the Yellen put is if it's not dead, it's being restruck much lower. And what do we mean by that? We mean that the Fed's reaction function to dips in the market is much less sensitive than before. In the old days with both Bernanke and Yellen, they for sure would have taken a pause at this meeting. There is no way that either one of those academics would have raised rates this past week. Yet
right.
Powell has showed he's a different creature and that he is going to stick to the plan. Now, the real problem, and this is where it gets a little nuanced, is that Jay Powell said something during the press conference that spooked the market a lot. And what it was he said the balance sheet unwind was basically on autopilot. And if you look at what happened during the conference call, during that press conference, that was when the market really sold off.
Yeah,
and
sure.
I have this great picture of this volatility whiz. It was one of my buddies on Twitter that writes a great newsletter on the VIX. He went and pulled up the airline, the airplane movie from is that the 70s or 80s? And there's a great scene in there with when the autopilot takes over, and he just comparing Jay Powell to that autopilot, and it really spooked the market because what the market was most concerned about is the withdrawal of the liquidity from the quantitative tightening. And the fact that they refuse to acknowledge that this is affecting the market and that they might change it just made everyone say, well, you know what, forget it. These guys are kind of clueless or at the very least not caring what the market does. So it made everyone
let me ask
on
you
the sell
right?
buttons.
By the current market conditions being the way they are, and the Fed not even acknowledging that shit's hitting the fan around the world, even forget a 10% market drop in the S&P 500 may not be a bear market alone. I mean, yeah, the Russell is now pretty much in bear market territory, but the fact that the FOMC is not acknowledging this, like everyone's thinking, well, what if we're even 10 or 15% lower by the next meeting? Will they then just start to say, well, yeah, maybe we should just pause at that moment? Like, how bad do things have to get before the Fed starts to provide liquidity again? And the situation could continue to become like a feedback loop that is of negativity that's going to just make things get worse and worse.
Well, that's what the market's scared about. And it's made worse by the fact that Trump is busy threatening to fire him. We're doing this Saturday morning. And Friday night, there was a Bloomberg story that says Trump discusses firing Fed's Powell after latest rate hike. Like, this is making it more difficult for Powell to go.
Is there even precedent for this? Can a president remove the Fed chair?
It's a legal gray area, and I see that Morgan Stanley came out and said that he can't. I think that he can go and remove him as the chair, and that he can leave him as a governor. But who knows what, Trump, he's, if there's anything you can say about him, it's that he's a wild card, and that he might even try.
He has pinned his presidency to the stock market, and I think it was a mistake from the get-go, because it just gives the market gods an opportunity, something against Trump. Like, Trump should have disassociated himself from the stock market from the start, because think about it. Obama had 8 years of bull market that he basically was participating in, and he handed Trump late business cycle. It was almost certain that over the 4-year Trump period that there was going to be a turn in the economy. And Trump, what does he do? He tries to say, no, not in my 4 years, and he tries to throw this massive tax cut and stimulus and saying, I'm going to be able to pull it off and go 4 years without a market pullback. But now, if we have begun a bear market, like I believe we are, then Trump is going to take the hit for this, isn't he?
Oh, for sure. And it's going to get worse. The question that I have for you is, do you think this latest information about him actually contemplating firing him, what does the market do Monday morning? Like, does this make the market, sell off harder? Like, does this create more uncertainty? What does this mean for the asset classes? This is unprecedented, and it's difficult to discount. Usually when markets see uncertainty, the first reaction is to sell. So is this going to be a situation where both U.S. dollar and U.S. stocks go down?
Well, it depends who is he going to replace him with. Do you think that Warsh guy would come in?
No, he doesn't want Warsh. Warsh is, well, I guess, don't forget, Warsh used to be, the reason he didn't choose Warsh in the first place was that he was too hawkish. It's kind of funny, and that was one of the strange things about the Warsh op-ed, was that he was generally considered more of a hawk than Powell, and that's the reason Trump chose Powell over Warsh, was that Warsh was much more hawkish.
And then that article comes out. That's hilarious.
Yeah, it's really interesting, and this is stuff we've never seen before. And I guess the one good thing about Trump is that
at the Bank of International Settlements, all the global central bankers have gone together at their country club and basically said, we're going to take the liquidity out of this market and see where asset prices are going to be. Like, is this maybe a bigger picture orchestrated event? I mean, I don't want to get all conspiracy theory here, but like it's almost like they're. I clearly, maybe it is. Maybe the problem.
I don't want to get all conspiracy theory, but do you think that there's some sort of cabal running everything? Is that what you're asking me, Patrick?
I'm just saying that when they get together in the country club, they have a scotch and they basically hey, let's plan the world money.
I think that the rest of the central bankers are probably mad at Powell, and I think that almost everyone but Powell and a few of those big-time hawks want the Fed and the U.S. in general to become easier, and that they know it's choking off growth. Now, the real question, like when the pushback from the people that'll say the real problem occurred in the past 8 years, not this not the Fed normalizing rates now. And I am sympathetic to that argument that the real errors were quantitative easing 3 and the slowness of Yellen raising rates, and that Powell is just desperately trying to do the right thing in their minds and normalize rates. The trouble about that is that every single asset price is priced for that quantitative easing, lots of liquidity situation. And if Powell is insistent on returning things to normal, what will be normal for asset prices is much, much lower.
Yeah, that's welcome to the bear market, ladies and gentlemen. Yeah. Let's move on.
So, Patrick, I think the FOMC decision was the biggest thing of the week. But what did you think it was?
Well, I really just wanted to talk about the sell-off that we saw in the stock market and really ask how oversold this market really is right now. I think it's just amazing to kind of look at some of these. So what I know, both of us prepared some charts and we want to talk about some things. Actually, I'm going to ask you first. Why don't you quickly go through the charts that you wanted to show, and then I'll throw up mine.
Sure. Well, mine aren't charts because I'm not as much a squiggle guy. I'm more of a stats guy. And my favorite guy, Odd Stats, had a great tweet that he sent out that showed the worst Decembers in S&P stock market history from 1923 to 2018. So the worst December was 1931, when it was the return was negative 14.5%.
Wow.
And then the next worst one was 2018.
Was that recent?
That was
But it's not even over yet.
Yeah, that's right. Well, that was my point, is that maybe we're, with this development on the weekend, maybe this will get even worse. And then from there, we're going to go, the other one was 1930. So 2018 was 12.5%, but the next worst one is 1930 at 7.5%. And then 2002 at 6%, and 1937 at 5%. So this December sell-off is just in another league in terms of how bad it is. And we can see as well from our one of my tweets from my pal here, Tavi Costa, he went and showed that the small caps are down the most that they've ever been in the history of the Russell 2000. So they're down 14.5%. So in December, that's the worst in the history of the index. And then if we go to the next one, where Occupy Wisdom has kind of sketched out the S&P drop of over 13% in the fourth quarter, and he walks through all the different times this has happened. And it's 2008 was the financial crisis, 1987 Black Monday, 1973 the energy crisis, 1941 World War II, 1929 the Great Depression, 1920 a major recession. Even I'm not old enough to remember that one. Yeah. 1917 World War I, and 1907 the financial crisis. So we are talking about some historic shit here going on. Like, this is just unbelievable.
Yeah, no, it's this sell-off has really come across as a shocker to everybody. Like, I have been bearish, and we've been more or less on the right side of this trade up for the last couple of weeks. But I'm just seeing at this moment such extreme readings on so many different fronts. I just think there has to be at some point a dead cat bounce coming here somewhere. I'm not in any way longer term bullish, but it's just crazy what's going on.
So I got to tell the listeners for one thing. So during this entire kind of meltdown, I was bearish at the start of it, and I probably turned a little more bullish earlier than you. And, I went from bearish to neutral, and then I was trying to take stabs at the long side. And every time I took a stab, I would go and I would be right, and I'd be like, here it is, this is the bottom, here it is. And I would get some sort of 1% rally, and I would tell you, and you would laugh, and you would stay short. And I have to give you credit. You stuck to the squiggles, and you kept saying, nope, until my target is hit. And I have to give you all the credit in the world, because you stayed short that entire time, and you refused to kind of get sucked into all those rallies. And that's the problem with bear markets.
I did get sucked into one rally. I was buying as of Thursday.
Yeah, you're right. But up until then, you had hung tough for a long time. And there was a lot of times that it looked like it might bottom.
So here's the S&P chart. And just like this sell-off is what we are talking about right here. This was the G20 pop where everyone thought that the trade war was coming to an end, and we called it the prairie dog there. Both of us felt that it was going to be a false rally. You were more right than I was in terms of how long it played out. But you can see here that this sell-off right now, we're down 14% in what is that, 21 days.
It's
in
just
21 days, down 14%.
And what's amazing is that all the fundamental guys will sit around and talk about, oh, nothing's changed in the economy, blah, 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 blah. But it just goes to show you that the don't trade the economy, trade the market.
Yeah, and so here you can see 79 days so far, 535 S&P points, 18%. So we're just a few percent away from that official. I hate it, by the way, that we need to be down 20% to call it a bear market. But Russell has already shown that we're in a bear market with a drop of 20%. I think it's a silly. We have our own definition of bear markets, right? Like, what in your mind is it? More the price action? Is it more macro? What defines a bear market to you in your mind?
Well, to me, it ends up being whether you should write pink tickets first or blue tickets. So when you have trades that
for our listeners that don't know pink and blue tickets, it's something you have to be an old timer like Kev
like
to know.
Kevin?
Yeah, it's but
Pink or sells, blues or
were you
buys.
around when you put the ticket into the chute and
no, we would type it, but we did have tickets, but we weren't putting it into the chute. Like, that was a little before my time.
But you know what? That was classic stuff back then, right? Like you basically would shoot the ticket down to the trading guys down at the on the floor, and then you could phone in and find out if you're filled over the phone. But yeah, those were the days, right?
Yeah, those were the days. But so to me, the definition of a bear market is one that whenever you seem to write the pink tickets first, they end up working. And I guess to me, it has more to do with the trend. Yeah, and all you have to do is think back to the last, 5 years, and it seemed to be when you wrote a blue ticket, you just waited long enough and you were on side.
We had so many guests come on to macro voices. The first one that comes to mind is Charlie McElligott, but I mean there were many guests that we had come on, and they were all talking about the massive decline in global liquidity by all the central banks tapering together. I think that first and foremost, liquidity matters over fundamentals. And this is where my view on the world is different than the majority of investors. Investors look at, well, what's the PE ratio? What's the dividend that the company's paying me? It's cheap or it's not cheap or it's expensive. They basically come up with all this. To me, it's about money flow. And when money is flowing, then prices go up. And when you take away that liquidity, then the entire environment changes. And so I think to really define a bear market, you have to look at that. But listen, Kev, I wanted to touch on just a couple charts in terms of the magnitude of how oversold we are. So I wanted to start off just showing this chart right here, which is the percent of stocks above their 200-day moving averages. Let me put this on a line chart. But we're just 12% of stocks on the New York Stock Exchange are above their 200-day moving averages. Now, to reverse that, that's 88% of stocks are trending below their 200-day moving averages.
It's ugly. It's shocking how ugly it is.
How quickly it became ugly. Let me just put this onto a monthly chart. When was the yeah? I mean, look at that. We are now lower than 2011-12. I mean, you are now going. The only time we're this low was 2009. 2008, 2009, and this is it's incredible. But that's how oversold we are at this one moment, and that doesn't in itself that's where I'm asking the question: is it oversold enough to buy? Right? And this is the percentage of stocks above their 50-day moving averages now hitting 8%. I mean, you have to again here look at going. Yeah, you basically have to go back to 2011 to find a period where we were this oversold. Often, these have led to buying opportunities when we get this oversold. The question is, when do you have the kahunas to buy the dip? Well, I tried earlier this week. And
there's
it's
going to
not.
be one.
It doesn't feel very good right now.
Yeah, no, there's going to be one big snapper like of a rally. That's
when the dead cat bounce begins, it's going to be big. But what's interesting, and you were commenting, I want to point this out. We haven't seen capitulation yet.
That's right. It's actually been very orderly sell-off, like it's strangely so. And part of me was thinking about this and going through it in my mind and thinking about the last 5 years and how the market had changed and how we had this grind higher, and everyone talked about the low vol, kind of grind. And so far, this selling has been almost the reverse.
Yeah,
it hasn't felt like, some sort of just get me out, people screaming. It's just felt like an orderly, every single day, someone's got a big monster VWAP in there and it just sells off. And it's kind of almost scarier in that it's just this grind lower, because that's almost worse for us as traders. Like that would be
it's so much easier if you can identify that capitulation moment, then you could fade it, right? Like that. It's like for good traders, it's the signal to buy. And so I think that we've lacked that one capitulation moment where those traders that have money on the sideline that want to try to buy this dip, they haven't got the criteria yet for what they want to see for them to trigger. Maybe we'll get it Monday morning, right?
Well, so you look at it the other way. I look at it as, instead of the guys on the sideline with the money willing to buy, I look at it as it has to be the last longs puke out their lows. I mean, puke out their stocks at the lows.
Yeah.
And to me, it's
it's also margin
problem.
Call selling. You know how many people I know that are getting margin called? They just were long way too much stuff, and and they're selling because they're trying. And more importantly, what's interesting, and this goes to where the breadth of the market, because a lot of the people that I know that are selling the good stuff to free up the margin to cover the stuff that's getting murdered.
Yeah,
right?
So that's a great point. And the other thing is, it's not just retail that has margin and has forced to sell. It's also the hedge funds. And part of this has to do with the huge redemptions that occurred in October for year end. And there was monster redemptions. And a lot of this is the hedge fund selling. And on that note, I was speaking to a smart, shrewd credit trader the other day, and he was telling me that in his square where he trades kind of corporate bonds, what he's noticing is people selling the good stuff because just to get liquidity. Yeah. And so they're giving away good stuff because they can't sell the shitty stuff.
But to me, that's a sign of that capitulation, right? Like that's when you are just indiscriminately selling because you owned too much risk, and you're de-risking at any price. That really, I feel that a market bottom's coming very soon. It might still come at a lower level, but I would argue that it could even happen in this 2018 calendar year. I mean, we could literally in the next week. I mean, the last trading day of this year is the 31st on Monday, right? So so we've got 5 full trading sessions.
Yeah,
right?
I don't disagree with you that there's a good chance that a bounce is coming. I was hopeful that we were going to get Trump to be quiet and Powell would come out and Powell would actually say, yes, we understand and we're watching market conditions. And that's all I think it would take. He doesn't need to go and actually change any of his outcomes or change anything except say, yes, we hear you guys, we're watching it. And I think the market would bounce. But now with Trump's stunt this weekend, about threatening to fire him, I think it makes it more difficult for Powell to come out and change anything.
Because it shows that he's letting the president bully him.
That's right. And I usually will say that's not going to matter. But in this case, if it's just a matter of shift in tone, I don't think he can shift tone after this latest, development. Yeah. So I have all of a sudden become much more worried about the Fed being able to save, the market.
Well, I don't think it's going to be the Fed at this moment. I think,
so you just think it's just going to be, after the selling is going to be done.
I believe we're in a bear market, Kev, and I think that the stock market will be even much lower 6 months from now than where we are today. But it doesn't all happen in one shot. Actually, let me quickly pull up. I was going to quickly show this chart, but let me go over to the S&P for a second. I want to just show everyone one chart. I want to going to the S&P. And I want to go back to 2007. And this sell-off right here in October to January of 2007, going into January 2008, we for about 105 days lost 330 S&P points, which was about 21%.
Yeah.
But notice that after that January low, even though by 2009 the stock market was much, much lower, look what happened in the next 4 months afterwards.
You got a tradable rally.
You had a tradable rally, and
so that's what you're anticipating.
What I'm saying is that we're in a bear market, and the market's going to go a lot lower. But I think that we're much closer to something like this right here,
Right.
and that it's just that once the everyone's just that had to sell sold, and that puke happened, then we're going to see something where if I use these little ghost candles that lets me put a thing like I would not be shocked if the market did something like this. I'm not trying to measure it out here specifically, but I just think that we're gonna have a reaction, and there's gonna be a tradable bottom. I'm still in that camp.
I don't disagree with you, and I was actually hopeful that after the FOMC meeting, that everyone would accept that the Powell put is struck much lower. The people that needed to sell would sell, and we would just kind of the last of the selling would be done, and we would drift higher after that because there's no more people that needed to sell. What I worry about on versus your scenario is that I look at the long-term money, and I think that come the new year when they're making allocations, that they're going to be sellers of U.S. stocks. So I was hopeful that this week would actually see much more of a rally that then you could short into. And what I worry about is if the calendar flips, that you might find that there's long-term big money that makes the decision, hey, you know what? We've been overweight U.S. forever. It's time to pitch it.
Oh, yeah, it's going to be really interesting to see because everyone gets their year-end statement in those first couple of weeks of January. How many people are not going to like what they see, and they're going to make those phone calls to their broker to get me out?
Right. And so hopefully we get enough of a rally before then to sell into.
So,
and that's kind of what I'm hoping for as well. So although I agree with you, and I do think we're just so oversold, and it just like the news has to keep getting worse, although it somehow manages, even when you think it can't get any worse,
I'm
going to
quickly nail 3 charts, and then we'll move on.
Okay.
So the first chart I want to point out, 52-week new lows on the New York Stock Exchange. We hit just over 700 on an intraday basis, 683 on the close. But we haven't seen this many new 52-week lows since 2016. But we're getting to levels that we only ever really see at capitulation. But that in itself doesn't guarantee anything. I just wanted to point this out. The other thing is that we had a huge spike in New York Stock Exchange total volume traded, and that may, in my mind, also be a sign of that capitulation. Do you disagree with that statement? Have a different view?
I have a slightly different view on the volume. Obviously, it's skewed by the triple or quadruple witching, so you have to kind of look at that. I'm a former derivative trader, and I can tell you that there was times that the volumes ended up being higher for us in terms of trading because of change of rates. So we would, instead of rolling futures, we would actually go and maybe turn it into the underlying, which made the volume much greater. Yeah. So to me, that's the volumes on the quadruple witching is artificial and kind of not a big deal. Yeah. What I do notice, though, is that on some of the credit ETFs, we had huge volume and huge pitching of those things.
We're going to talk about that a bit later on in the show,
So I'm hopeful that some of those things were actually, capitulation lows.
Sure. And so the last thing I wanted to show was the put-call ratio on the CBOE. And this I always say, when there's a huge demand in put buying, that is something I think is a tell that people are really panicking. And so we've now hit multi-year highs on this put call ratio. And so it just shows how really oversold the market really is at this stage.
Yeah, so to sum it up, we're in uncharted territory. It's just washed out like we can't believe. There will be a tradable bounce from how big.
Are you trying to still buy right here?
Yeah, so there's no way I would be getting short in here, and I still think that the better trades are to write the blue tickets first. Bear markets have just snappers of rallies. It wouldn't surprise me at all if we had 2 days and the thing was up 6%.
Oh yeah,
yeah,
for sure.
And
I want to try
fast.
clip it. So let's see whether that opportunity comes. I'm trying to buy the dip here. Let's see if I catching the falling knife continues to make some fresh new cuts on the hand, right? Kev, let's move on to this week in trading history. Now, you took the opportunity to dig something up. I'm curious what you found.
Well, I went back to December 19th, 1987. And on this day, Ivan Boesky was sentenced in the biggest stock trading scandal in Wall Street history. And for those who don't know, Ivan Boesky was the kind of the figure that Oliver Stone based his Gordon Gekko, the greed is good speech and everything. Like, that was the original Gordon Gekko. And it was back in this time in 1987 that he was actually sentenced and sent to jail. But what I want to talk about today is not Ivan Boesky, because Ivan Boesky gets a lot of kind of headlines and stuff. But it's something that another guy in the whole story, the Michael Milken, the junk bonds, that I just love. And his name is John Mulheren. And he was just a kind of a trader's kind of trader. And
was he the same firm as?
No,
Boesky?
so he was his own kind of guy, and he eventually went to jail for Boesky in terms of what he did with Boesky, because he refused to rat on him. Like, he was true kind of Goodfellas. He refused to kind of make a plea bargain and stuff, so he went to jail. And he's just kind of, I'm going to read you some stuff from Den of Thieves. Den of Thieves was a book written by James Stewart, and it was about the whole Milken junk bond era with Ivan Boesky. And I'll just kind of go through it because it's just a fascinating time. In 1981, when Conoco, the America's 9th largest oil company, was acquired by DuPont for a staggering $7.8 billion, the takeover frenzy really started to kick in. The deal, the biggest in history by far, involved no less than 4 competing suitors: Dome Petroleum, Mobil, the Seagram Company, and DuPont. All needed armies of investment bankers and lawyers. Basically, every major firm on Wall Street was eventually swept in. It was an arbitrager's dream. Conoco's stock traded at under $50 when the imbroglio, don't know how to say that word, I don't know if I'm doing that right, began in May with a hostile bid from Dome at $65. It rose steadily before DuPont finally won the bidding in August, offering $98 a share. So think back to this, like this in 1987, and we all remember, but we all have heard stories about how
like a barbarians at the gate kind of stuff.
Yeah,
right?
this is definitely, the environment that they were experiencing. For an arbitrager, there was almost no way to lose money on such a deal. But Boesky's performance, drawing on every bit of intelligence at his disposal, was awesome. He drove his lawyers at Fried Frank, led by Stephen Fraudin, to produce research on legal questions, including complicated antitrust issues with respect to mobile. He was on the phone constantly with Mulheren and other arbitrageurs, watching volume and patterns in the stock, sniffing out clues for the next inevitably higher bids. Now, this is the part of the story that I love. Okay, so think about Boesky. He's got his big position. He's watching every tick in the market, and he's kind of wondering what every single player is doing.
Right.
And then there's Mulheren. Mulheren was they called him the enfant terrible, which is, like of the arbitrage community. And he says he loved to do battle with the arbs, most of whom he considered fat and lazy, and boasted that he usually ate them for lunch. Now, this is my favorite part. One of his favorite pranks was to initiate heavy buying or selling about a half hour before a major market announcement, such as an antitrust court ruling that might make or break a merger deal, was due. In fact, Mulheren would have no idea about the outcome, but the sudden activity coming across the tape would suggest that he had advanced knowledge. Herbs would go crazy, especially Boesky. What did you find out? He'd ask breathlessly. What do you know? Nothing, Mulheren would calmly reply. I just did this to fuck with people's minds. You're insane, Boesky would scream. You're so juvenile. Then he would hang up and Mulheren would roar with laughter. And this is just like makes me laugh so much. And I just love this guy. And he's my kind of guy that he's just kind of thought that this was an hilarious prank to pull, messing with the tape right in front, because people, what you have to realize is that right in front of announcements like that, it gets very thin. And the market, you can move it with very little, actual.
Yeah, because nobody, everyone's already got their position and they're now just waiting for the announcement, right?
That's right. So I just love Mulheren, and he went on after he went to jail, and he was actually friends with Bruce Springsteen, and this guy, just all the stories about this guy made me just love him to death. And after he went to jail, he came out and started a trading operation, and I believe he eventually became a market maker and made himself a fortune, and unfortunately he passed away at the age of 56. But I love the story. I think if you have any interest at all, you should go read Den of Thieves by James Stewart, because it's a great book, and make sure you pay special attention to John Mulheren, my hero.
All right, let's move on. Kev, what do you have in store for us for the WTF clip of the week?
Well, speaking of 1987, Alan Greenspan got out in front of the cameras. I think he's got a book to peddle. So he was out in front of the cameras, and he said something, and I couldn't help but make an Alan Greenspan video. So without further ado, here's Alan Greenspan.
It's not a surprise, and human nature is not a surprise.
Looks like I missed something.
The volatility is a function of how we speak, think, and feel.
Hey! What's this lying around shit?
Do you think we're still in a bull market, an equity bull market?
Not really, no, it's beginning to fumble. You can see it by reaction in recent days.
What? Over? Did you say over?
It would be very surprising to see it sort of stabilize here and then take off again.
Nothing is over until we decide it is. Was it over when the Germans bombed Pearl Harbor?
But it's happened in the past. However,
Hell no!
German? Forget it, he's rolling.
at the end of that one, run for cover.
And it ain't over now. Because when the going gets tough,
I don't know.
But more.
I don't know anybody who knows.
the tough get going. Who's with me? Let's go! Come on! Ah!
Okay.
So, Patrick, I know Greenspan is not the most dynamic of speakers these days, but I couldn't help but think when he told me that it was over, the bull market was over. It just immediately popped to mind, Bluto from Animal House. Nothing's over until we decide it's over. So, what do you think? Do you think Greenspan's right? Is it over?
Well, yeah, I mean, I think if the first half an hour of the show has shared our opinion already. I do, but it's interesting. Again, it seems like everyone but the Fed knows, right?
Well, and I worry about when the architect of the Fed put tells you it's over. Maybe he knows more than we think. Maybe the Fed does know, and maybe this is all the plan.
Well, yeah, I do believe that. I don't know. I don't want to even again go with it being a conspiracy theory, but I feel that
you don't want to do it. But here we go.
I just think that the market cycles and recessions and things like this are things that always happen, and the Fed knows they have to let one of these recessions or mean reversions in the economy happen, and they slow things down to trigger it. I honestly think that when they've been raising rates, they know that they're going to raise rates until the whole economy stalls, and that's just what they do.
Well, So now that we're on the same page as Greenspan, I should be really worried.
All right,
let's move on. Okay, Patrick, now it's time for Tales from the Trading Desk. I know when I listen to you and you start talking about vertical spreads and all these different things and on options, sometimes even me, having traded options for a living and made markets on them, I'm kind of like, what spread is he talking about now? What does he mean? And you have some lingo and some specific positions that you like to put on. And I encourage you to kind of go over it today and actually explain to people what those spreads are and where they're useful. So why don't you go through and lead away?
All right. So really what we wanted to dive into here in the Tales from a Trading Desk is just simply looking at option spreads and why you would put them on. And to me, I always describe option strategies as tools on a tool belt. When you need a hammer, you pull out of your tool belt a hammer. You're choosing the tool for each environment. And so as the market environment changes, certain option strategies work better than others. And right now, we have a considerable spike in volatility. And volatility makes options more expensive, and this has to be somehow offset. So just to kind of give everyone an idea of what I mean by more expensive, is I'm going to use a simulator that's available for my members at Big Picture Trading. And what I want to do is I'm going to just set here in the simulator $240 price, the starting price. And we're going to put in, let's say, the current implied volatility around 26.6 for the SPY. And I want to just show that if I am looking at just an at-the-money one call option to January at the money 240 strike, that option is being priced at $7.28. And just if you were buying the same option, if all the variables were the same, and you were buying it when vol conditions were closer to 10-12%, let's say, then let's say the starting volatility was 12, like the VIX was down in those low teens, that same option would be $3.44. So
it's a huge difference.
It's a huge difference. So somebody today that wants to buy a call option on the market is literally paying double what they would if they were buying this a month ago.
That's right.
Right.
So it's almost like the cost of insurance has gone up.
Well,
right?
That's for sure. That's the whole point
so
of watching. So
that's a way
the
to think about it, is that the cost of insurance has gone up.
But what it does do also is therefore it reduces your risk-reward proposition. By you having paid more for the option, you have to be that much more right in order to get the same return. And therefore, it throws off your entire benefit of trading often.
Right. So what do you do when you're stuck with this? Because you can't just say, I can't trade because the implied volatilities are too high. So what do you suggest?
So this is where the spreads come in. Now, what is the other risk, though? I want to just highlight the other risk. So let's just go back here and change this setting back to 26.6%. So assuming, look, the volatility is wider because we now are, let's say the average day by day volume, but is, I meant to say the trading range is 50 S&P points in a day is par for the course now.
That's right. So obviously the chance of a large move is the market is saying the reason you're paying more for insurance is because the chance of a large move has increased.
Exactly. And so if everything being equal, maybe this is the right price for the option. $7, reflecting the fact that you could be pretty much up almost 100% on this option in a day. The option has to be more expensive. But the risk lies in volatility normalizing, or Vega risk, while you own this
option. And Vega
just
is the Greek that basically says how sensitive an option is to a change in implied volatility, not actual volatility.
What I have here is the implied volatility bar. And so what I want to show is that if somebody bought this option and paid $7.28 for it, if you owned it, let's say for 3 days, just the theta, or the rate of it, the time decay would have, let's say, dropped it to being down $40 or.
So 1 second. So theta is another Greek that explains how much an option decays every single day.
It's the cost to carry. It's how much you're paying. It costs you to own this option every single day. The point is that if all things being equal, you bought this expensive option and volatility was not a variable, then everything is fine. You just got paying a little extra time premium for owning it. But what happens if there's a huge market rally, but volatility normalizes back into the teens? So notice here, if the price just was unchanged, just so we can see the impact, I'm going to take volatility here down to 15%, right? Notice here that option dropped to $4. Somebody who owned this option, even though the price never changed, saw them lose over $3 on the value of this option because Vega went against them. The volatility was their enemy.
And not only that, often in a rising market, that is what happens. The implied volatilities come down.
Right.
So that is the worry.
That's a big challenge. This is why the lottery ticket of the put is always interesting, because volatility is your friend. And so when the market crashes and volatility spikes, you profit twofold. But when you buy an expensive call at a market bottom and you're right about the move, you actually are delta right, but Vega wrong.
That's right. Okay. So what do you do about that? So how do we combat that?
Exactly. So by opening a spread, we reduce the impact that
so
volatility
why don't you tell
has.
people what that spread is and what that means?
So let's as an example here. So rather than just buying a 240 call, let's in this example sell. Now normally this would be done as a combination trade, but you could be legging in. Depends on which broker you're at and how they deal with it. But let's say we went and opened a 250 or sold a 250 call against the 240. So now notice here when I load this. What we have here is we paid $7.28 for the call. We collected $3.46. We have a net debit of $382. And what I'm going to show you here is that if we take volatility and we drop it, let's say down now to, let's say 17.6, we basically saw actually let's drop it 10 vol points. And so we are 16.6. Notice here that on the call option, the red dotted one, we are down $263. But on the short call, we're up $220. So it wasn't a perfect Vega offset, but basically we were able to remove the impact volatility has had on the trade, hedge it out. It's a way of making more of a directional call on the market and having and removing volatility as a major input variable in determining whether you're profitable or not.
Right, but what I want to point out to everyone is what they are giving up by this, because in the markets nothing is for free, is if we were to have an outsized large move to the upside, let's just imagine it was a 20% upside jump, which will never happen on an index, but let's just say it did. Then this position would obviously not profit nearly as much as just the straight option. So that is what you are foregoing. You're foregoing that kind of unlimited upside for a little more certainty, and you're paying less in terms of exposing yourself to the vagaries of the Vega.
So instead of forking out $700 and having an unlimited upside, and you have to beat the $700 nut in order to be profitable as it's time decaying, you now outlaid only $300 and change, and you turn around and limited the upside, but you've removed or managing the risks of things like volatility. So in this current market environment, putting on debit spreads, I think, is a very good way of trading a turnaround in this market.
So let's just talk about what a debit spread is. A debit spread is something where you are buying a more expensive one and earning less on the other side. So it would be on a call. You would own the lower price call and be shorting a higher price call. And on a put, you would be buying the put that's at the money and then selling it out of the money put, which would be lower.
A debit spread doesn't have to be at or in the money. Like you could open a different strikes.
You're right. I'm sorry, but I'm just giving you an example.
But you're always buying the main option and selling a farther out option to help reduce and offset the different risks to the trade. So you're always going farther away for less credit on the farther strikes.
Yeah, that's
Anyway,
great.
it's the kind of stuff that we do at Big Picture Trading, and I think it's an interesting way at this moment of trading this market because of the very high volatility that we're in, and the Vega risk that we have. That if we have any market bounce, volatility will come back and normalize. You need to when trading options, you need to have some way of hedging that out, and I think debit spreads are a great way of doing it.
That's great. Okay, Patrick, it's time for the top 5 things to watch next week. But before we do that, let's review what happened last week.
All right. So last week, our number 5 was Johnson & Johnson and the breakdown. But really, it's really hard to comment on Johnson & Johnson at this moment because it's just being hammered with the whole market. It's hard to even say that this is a news-driven thing anymore. Right now, the whole healthcare space just keeps getting hammered.
I agree. It's all stocks. The beta has gone up, and it's all about liquidity, and it doesn't really matter. And so I don't think we should spend too much time on that. How about number 4, the dollar index? Was the breakout for real?
Well, you know what? For me, I thought that with Powell saying that he's essentially going to remain relatively, even though I guess you can say he was more dovish than last meeting, he was still very hawkish. I still thought this was dollar bullish, and yet the dollar initially broke down, but then has bounced since. But we haven't broken out, but I still think dollar's going higher. What's your take?
Well, I think that if Powell continues to be overly hawkish, that ultimately that will be dollar unfriendly because it's going to force the U.S. dollar or the U.S. economy to slow down, which will ultimately be negative for the currency. So
but aren't the other anyway? Point made. I don't agree with you, but let's
disagree.
Move on.
And so far, though, I think that was a prairie dog. I think we argued about that last time. It was a prairie dog. You were getting all bullish on the breakout, and
I still think it's going to break out.
Yeah. So you know what? We'll see.
Let's see. Anyway, Cameco. Look, Cameco, just like Johnson & Johnson, everything's sold this week. That's just par for the course.
It's again, it's hanging in there. The action hasn't been that bad. I still think uranium's a great place to hide. And on a relative basis, it's been just fine.
Yeah. Number 2, the Russell being a tell. Yes, that answer is yes. And number 1, FOMC. What was just give us a quick.
Well, no, I think we've already gone over it. It was just a disaster, and it was the number 1 thing to watch, and it did drive markets the whole week long, and it's going to continue to drive markets. It's the biggest. It was the most exciting FOMC we've had in ages. It was the first one that wasn't preordained in a long, long time, and it'll be interesting to see whether the market participants can force the Fed to pause on the next one.
Sure. Let's move on to the top 5 things to watch next week. Now, it is holidays next week, so the market is closed on the Tuesday, but usually the Monday and the Wednesday, which is the Christmas Eve and Boxing Day, are traditionally incredibly low volume. But I'll tell you, I'm so curious what's about to happen on that Monday. Don't you?
Oh yeah. Well, especially with this news about Trump, wanting to fire Powell. I just think it's made it so.
Traditionally, it's a very low volume day, right?
Yeah. I can't believe anyone's going to actually do anything. So, it's not like some money manager is going to get up and say, "Oh, you know what? It's the 24th. I'm going to go and make a big sale." And so I still think that it's going to just be a low volume, all erratic day.
All right. So let's actually go through our top 5 here. So number 5, Kev.
So number 5 was Nike, and even in this horrible tape, it managed to blow out earnings, and it actually rallied on Friday. It was one of the few kind of standout good stocks to watch.
So here, let's just have a quick look at the chart. So okay. You know what though? I personally still think that this chart looks awful. Look, you know what? It did have a good earnings. It did pop on this, but this chart doesn't look much different than a majority of other stocks out there. I think you're just putting too much attention to it. I think Nike's going to trade like the rest of the market for moving forward. We'll see.
Okay, number 4.
Number 4. I wanted to talk about gold and gold miners acting as a safe haven. So what we have found is that gold's been catching the bid, right? So I'm just going to use actually here. Let me put up the This is the GLD, but let me pull up gold futures here. And so gold has been working its way higher while everything else is being sold. And even the gold miners using the GDX, they've held up pretty well. This chart looks much better than Nike. And but so to me, it looks like people are going to gold miners here during the storm. But what I'm curious is if we're going to hit a short-term bottom sometime here in the stock market, will that therefore end this little rally in these gold miners? That's what I'm watching. Like, can this trend just continue? Is this a beginning of something bigger? What's your take?
Well, I think it's going to depend on why we bottom. If we bottom because the Fed finally acknowledges that market conditions are affecting their decision, then I think that what that will imply is that you can expect slightly lower rates going forward and that gold will be just fine. But if they go and they cause, if everything just keeps selling off because they say, "Damn the torpedoes!" Like we're driving full steam ahead, then I think you're going to find that it'll be difficult for gold to continue to rally because liquidity will be sucked out of the system.
I'm curious. It's definitely one thing that I'm watching next week. So, Kev, what are you watching for number 3?
Well, number 3 was high yield and senior loan ETFs. So we have HYG or JNK. We mentioned earlier how there was big capitulation kind of volume days. One of the ones that I look at that a lot of people, this chart's there. You can
this is
see.
The chart of the JNK. And just to point out, I want to just make one comment here. This sell-off right here, while the sell-off was pretty nasty, it's still, when you compare it, though, to how bad things were in 2015 during this sell-off, it still can get a lot worse here.
Well, you're correct. The one thing about the 2015 sell-off is that it was driven by energy. And so,
you don't think it's going to be this time around with
not
oil
as
crashing?
much. It was in 2015. The interesting thing was, although the ETF was getting hammered and the indices were going down, it was actually just one segment of the junk bond market that was having trouble, which was all the energy bonds. So you had all these bonds go from par or 90 cents on the dollar to like 20 cents on the dollar because they were pricing in just the end of the world in energy. And the rest of the average junk bonds were fine. And the rest of the industry seemed to be trading perfectly well. So it was much easier to navigate and to do kind of avoid the mistake by just staying away from energy. This one is different in that it is across the board selling. And although
it could get a lot worse.
Oh, for sure. It could get a lot worse.
Just to show where we are with the credit spreads. I mean, we've now gone to over 500 basis points over Treasury on the high yield credit spread. So just for our listeners that don't know what this chart is, this is how much interest a high yield bond has to yield over that of the rate of Treasury bonds. And when there's a lot of uncertainty, especially when there's a risk of increase in default rates, then this usually spikes. And we definitively broke out here. You wrote a blog recently on that, didn't you?
Yeah, so I was arguing that we might have peaked just like we did in 2014. If you go and look at 2014, the market action looks very much similar. It was that rise from the summer to the December, it corresponded with actually the FOMC meeting up to December 2014, and it popped to 512 from 250, and then it went down for the next kind of month and a half to 2 months. And that would actually be very similar to what you're predicting in the stock market in terms of that would correspond.
I think at some point we're going to reach a puke point on everything, and everything's going to just mean revert and bounce the other way. But it's still a bear market. I don't want anyone to misinterpret me. I'm still bearish into the middle of next year, but it's just I think things are just so oversold that these things have to
right.
But what was the other one you want me to look at?
Yeah, so let me just talk a little bit about the BKLN, which is the bank loan ETFs. This is an interesting new product because in the past it's relatively new. I think it's only been around since 2007, the index, and what it is it's senior loans. So to actual corporations. So a loan generally gets reset in terms of interest rates. So there's not as much an interest rate component to this because the loans are getting reset as rates go higher. You get reset with higher rates. So it ends up being much more of a pure credit play. And what you've noticed, if you could back that chart up and actually look and go back to, we had a dip like this again in 2015, again because of the oil loans. But this latest, decline is eerily similar, and it actually looks like it wants to bottom at the same level. Like, why don't you give me some squiggle advice here?
Well,
is that a double bottom?
I mean, it's not a double bottom until it actually holds the line there.
Yeah, so there we go. True technician.
You can't call this. It's just retesting where it was previously back in 2016, right?
Right. Okay.
That's the only observation you can make at this moment. I would actually argue it's going to blow through it.
Oh, do you? So you're bearish. Okay, so I'll tell you one thing that leads me to think that maybe you might be wrong, and I'll tell you what it is. I just read that the ETF manager had oversold some extra loans to make extra cash to basically get ready for more redemptions, because what's happening is they're getting overwhelmed with redemptions. And so the ETF manager has kind of got out ahead and sold some extra loans because loans are difficult to sell. It's not something you can do. So they've gone out ahead and got themselves with the highest cash position I think they've ever had. To me, when an ETF manager is overselling and getting less long an asset because they're anticipating more redemptions, it kind of feels to me like
Kev, you're going to be wrong. You're going to be wrong. Listen, right now, you'd have to explain to me where the buyers are going to come from that are going to drive this as this amazing opportunity. Because if you look at the market, nothing is an opportunity but this, right? I mean, the entire market is so oversold that when buying comes in, I don't think you're going to have anyone wanting to buy senior loans. They're going to want to be buying energy stocks that are cheap and other types of assets. You're going to be wrong. It's going to go lower. That's my call.
Okay, sounds good.
Let's go number 2. I wanted to know, how low will oil go? And to me, the selling on oil has just been relentless, right? It's so here I'm going to just pull up the chart here on oil. And we have seen this wipeout. Like we were talking about earlier when David Rosenberg made that comment. But I mean, we're down 41% in basically less than 3 months.
Yeah, it's brutal, and it's
most people don't realize how big the oil market is, right? I mean, is it something like $1.7 trillion?
I'm not sure, but not only that, it goes into the price of oil goes into absolutely everything.
Everything, right? There was that one stat that they put out there that basically the oil market is larger than all the basic material markets combined together. So you take the copper market, the gold market, the iron ore market. You take all of those markets and combine them all together. The oil market alone is still bigger than all of them combined.
Right, and it's the perfect indicator about the global health of the economy. The health of the
and this is why I feel that it's pretty safe to say that there's a massive global economic slowdown well underway here.
Right, and it's interesting that everyone else sees it except the Fed, and they don't seem to care.
They don't seem to care. So, Kev, what's number 1?
Will we see a Christmas market bottom? Is Santa going to come?
Right. And so I think that if we're talking about things that we're going to watch next week, how could we not watch whether this market that is just crashing lower, whether or not this is going to stall here? Like, let me break this down to even just an hourly chart so everyone can just witness the relentless selling we witnessed in the month of December. And the question here is, in my mind, is when will we see a tradable low, and how low will it go before it finds it? I personally felt that this kind of 2,500 level was a very logical way. My squiggle lines were all pointing there, but there's an extended measured move which I want everyone to sort of watch, which is this number around 2,400. It's 2,390 in this area. And that's an extended move from the technical stuff that we watch. I think that this would be a very logical place for the market to pause, but I also thought it was going to stop at 2,500. So the selling is just relentless, and it'll be curious whether next week is it the 27th is the last day of tax loss.
I'm not sure about that. But here, I'm going to give you my prediction on if you were to see a bottom, what it might look like.
Sure.
Every single, well, not every day, every single day, but most days, it seems like we get up and it rallies in the morning, tries to look like it might do well, and then it rolls over and closes on the lows. What I would like to see is a day where we wake up and it opens on the low. So I'm actually hopeful that with this Trump, news with Powell, that come Monday, we might see a gap lower that is bought. And to me, that would be the signs that we've reached the bottom end.
Especially
wouldn't that be something
if we gapped lower like 50 S&P points? And
I don't know. I don't know. I'm not sure how the market is going to take this. But wouldn't it be something if we gapped lower to your squiggle, the 2390, and then just rallied from there?
You know what? I'm positioned for that. My wallet would like your idea a lot. Anyway, so let's watch and see how this plays out. So that was our top 5 things to watch this week. Kevin, what's your parting words of wisdom?
Well, I heard you talking about liquidity, and when you were doing that, I had to pull up a quote from one of my favorite traders and a guy that we've been talking about this week, which is Stanley Druckenmiller. He said, "Earnings don't move the overall market. It's the Federal Reserve Board. Focus on the central banks and focus on the movement of liquidity. Most people in the market are looking for earnings and conventional measures. It's liquidity that moves markets."
Stanley is one of the smartest guys out there, Kev, and this really ties into what I try to cover with my big picture trading members when I always say that over the short to intermediate time frame, it's always a function of liquidity and understanding the next direction of the market. So Stanley Druckenmiller, not Drunkenmiller, but maybe he needs some Alka-Seltzer, right? But anyway, but Stanley is just so super smart. It's I love the quote.
Well, did Stan steal it from you, bud?
No, actually, he did not. He is one of the true legends out there. I have to say that I stole it from him.
Okay. Well, I just want to take a moment to thank everybody for listening. I wish everyone a Merry Christmas, Happy Holidays, a Festivus or whatever it is that George and his dad celebrate. You know that story, Festivus?
No, I don't.
You don't know that, George? Well, just look it up. Go look at Seinfeld and the story of Festivus.
Okay, I will.
Okay.
Anyway, thanks everyone for joining us. Happy holidays. We do have an episode that is going to be airing next week, so it is. There's going to be no interruptions in the show, so we'll be back online next week to see how this all played out.
Right. So go, and if you want to receive the weekly email, go to sign up at markethuddle.com, and if you want to check out what I'm saying, you can go to themacrotourist.com and also check me out on Twitter at Kevin Muir.
And you could also follow me at Patrick Ceresna on Twitter or check out bigpicturetrading.com. Anyway, thank you everyone for joining us and have a great holiday.